Welcome, everyone. My special guest again and a friend, Matt Johnson, who I do a number of deals with. Today, we're going to talk about a topic that's pretty interesting for many of you investors out there, which is how to finance or how to go about financing a multifamily deal. So, Matt, how's it going?
Pretty good, man. And yourself?
Good. How you doing down there in San Diego?
I'm actually close to San Diego, Orange County area, which is about probably an hour from there. But at the same time, we're doing good. Just loving life, not having to go anywhere right now for meetings and all that kind of stuff. It saves some time with the traffic in the area, of course. So
awesome. How's business?
Just for a little background, I'm a CPA, fully renovated over 1,000 houses now and flipped them. We have about 20 million lent out to different flippers in different markets around the country. And we have some long-term strategies for buy and hold rentals now on the financing side. We do a lot of value add multifamilies, have a debt fund set up for investors to invest with us, do a lot of different strategies like that in real estate in general. And I even invest in outside syndications and projects and things like that too. What's really cool that I was excited to talk to you about was some of the financing that's out there right now. So we're, traditionally for a buy and hold investor, you're going to go to Fannie Mae, Freddie Mac, and you're going to get right now, 3.5% money in that range, maybe 4% if the rates just upticked a little bit in that range for a 30-year fixed. And you're limited to 10 properties in your own name, maybe 10 in your wife's name as well. And you're in a position where you need one for your primary residence. Maybe you want to keep one available for a vacation house and just have some freedom there, not use up all of them. And then you got 8 left, right? And if you're talking about properties in the Midwest or properties anywhere, they may not make more than a couple $100 a month in cash flow with that financing on there, as well. And so, you get to 8 or even 18 with your wife, and you may not be at a position where you are fully covered with long-term cash flow. And so there was a void there because after that financing, you're trying to go after that private financing. You may be trying to go after the local bank financing in those cases, and those local bank financing on the single family through fourplexes typically would give you, maybe a 5-year balloon, a 7-year balloon, or a 20-year amortization on these single families, or even require you to do a package of properties at a time to be able to get these refinanced. And there's other outside packaged financing out there where you're doing a pool of financed properties, and that might be in a little bit better term, but they're always linked to each other. So what happens is you sell one and you got to pay 120% of the loan off. Because
are you referring to
to
the blanket loans?
Say it one more time.
Are you referring to the blanket loans?
Yeah, that's correct. The blanket loans. So those blanket loans have inherent problems with them just because they're all combined. They might have a 5 or a 10-year term versus a 30-year fixed type term, which I believe now the blanket loans just came out with 30 years as well. But at the same time, previously, there was very limited opportunity there for a 30-year fixed.
Yeah, and effectively, at least when I was back in the day doing it through, I think it was CoreVest or something, it's looked at as like a commercial loan, right? So you have to put more down. You can't cash out as much as you can on a single family. Right. And the cost to even do the appraisals and everything is much higher. It's kind of a pain in the butt. And it ends up not being as lucrative as you would think.
Right. Especially when there's a 5 or 10-year term and you're going, wait, I got to sell this entire package in that period of time. And every time you sell one out of the portfolio, if one's a loser or one just you have a buyer for and want to make money off of it, then it's attached to the other ones where you got to pay down.
It's really 20% complex
of the other one. Right. It's a challenge with all those issues. Right. And then you also have private financing, which usually comes with a little bit higher of an interest rate. Maybe it's interest only, maybe it's shorter term because it's hard to get an investor to come in and put it in for 30 years. So there's inherent issues and problems with the typical market after you're dealing with Fannie Freddie. Now there's financing out there that we have and that I purposely went out to set up to get because I'm using it for myself across the board and holding a bunch of houses long term. But there's that same commercial financing we talked about on the blanket side, but it's on single family homes through fourplexes that are individual properties up to 75% of the market value at around 5.5%. So it's maybe 1.5% higher than the Fannie Mae debt, but you can do unlimited of this, and they loan it to your LLCs, and they treat it like a
Oh, wow.
commercial loan
Okay.
where they're looking at your
Yeah.
debt service
Hold on
coverage
here.
on that loan.
You just said there's a lot of nuggets you just said. So
Yeah,
I'm going to
sorry.
break this. Yeah. So I'm going to break this down, right? So three big items. One, multifamily versus single family. Two, you have lower rates and roughly a 5 to 10% higher LTV amount than I'm used to. And I got to explore this unlimited loan thing. So let's start with the last one first. How do you now have a way to have essentially unlimited loans on your balance sheet?
Because the commercial financing sources specifically saw this void in the market that were normally designated for multifamily deals and things like that, and said, hey, you know what? There is no 30-year fixed rate money out there after the Fannie Freddie stuff is used up. And Fannie Freddie has their challenges because they're basing it off of someone's income, and they know real estate investors sometimes purposefully show no income. Like I've done cost segregation strategies to get 400 grand off my taxes and strategies like that. And, so this is out there now because now you're able to go through and do this for business purposes for rental properties. They're looking at the rental income. It's got to be rented. It's got to be, in good shape and long-term type hold situation. And based on the appraised value, they'll go through and either refinance you and pull all your costs out of the project, up to 75% of the market value, or you can buy a property that's turnkey and rented this way, and put 25% down, and you can get a 5.5% or less interest rate if you buy it down with points. You can buy it down, I believe, all the way to 4, which is crazy. It gets expensive. You don't want to pay that many points, but so if you're going to hold it long term, that's interesting. They usually do like a 5-year prepayment penalty. So if you pay it off in that 5 years, because this is commercial paper, it's not Fannie Freddie stuff. But it's 30-year fixed to an LLC specifically. They don't even want to do it to someone's personal name because it's for business purposes, and they're using the debt service coverage on the rents to justify the loan amount.
So this is really powerful, right?
Huge. Yeah.
So because again, back in the day, I believe most commercial people had to have at least 4 units to be able to. So it had to be multifamily.
Right.
Are you saying that if I went to Kansas City and I bought a turnkey for $120, and it rented for $1,100 a month, cash flows $300 per month, decent ROI, they in my LLC buys it, they would give me a loan to purchase that property.
Yes. To your LLC.
Yeah, that's right.
Exactly. On a 30-year fixed.
So, okay. So we got so typically with LLCs, they require 2 years of proof of income. Is that the same thing?
Nope. Because they're qualifying it like a commercial multifamily. And a commercial multifamily, they're saying how much income, net income after expenses, is this thing going to produce in positive cash flow. And they require usually a 1.1% debt service coverage ratio, which means that it's got to make 110% of the mortgage payment to qualify. Now, do they want to see some reserves that you have in your account? Yes. Of course, they want to vet you and qualify you personally as well. I believe their minimum credit score is 650 or 680 at the moment. And there's some exceptions they can make depending on the situation because it's commercial. And so that financing is massive on the singles through fourplexes, right? So, and what's really cool is there's always been a massive void in this space for the smaller multifamily buildings. Typically, you're going to, on anything above $1 million, you can usually get, and most of the brokers don't like $1 million multifamily loans, right? They want the things to be a little bigger, but they'll still work with you. You're talking about, a very small group of people or very small group of lenders that will loan between like $1 million and $2 million or $1 million and $3 million, and a much bigger group, like hundreds and hundreds of larger investors that'll loan $10 million or more, right?
Yeah.
So, and what's interesting is normally you're going to Fannie Freddie and you're getting that 10-year balloon with a 30-year fixed, or a 7-year balloon with a 30-year fixed,
down at least,
or with a 30-year amortization, right? And you got that balloon. And so that means you have interest rate risk, which we all know the only way it can go is up. I mean, right, maybe it goes down a little bit in the meantime while the Fed is messing with everything, but long term, there's a big risk of it jumping to, 7-8% again, back to where we were, before the 2008 crash potentially. And that, really hurts long term when you're dealing with a balloon where property values drop in the meantime, especially on multifamily. And so now, and also there's very little money out there available for the sub $1 million loans, right? The stuff that you're usually going to local investors, maybe some private, smaller hard money lenders, or you're going to local banks that want to give you that same 5 and 7 year term because they don't want to take the interest rate risk.
You're at 8% rate starting out.
Yeah, exactly. And so you're doing those types of methods. And now we have a program for 5 units to 20 units for C or better properties, C plus or better usually properties, anything from $2 million or $250,000 to $2 million for multifamily on a 30-year fix for multifamily. Same loan product.
So you're doing so this program works for both multifamily and single family. Is there any limit on the loan amount for single family?
No, not that I'm aware of. It might be a couple $1 million or something like that, or $1 million.
No, I'm sorry, floor, because I've seen lenders say, well, we won't lend anything less than
Yes, 75,000 is the minimum loan amount, so that means the minimum market value is 100.
So this is for all you you buyers out there. This is what I'm hearing. Assuming a 25% down, to put it in our terms that we talk about, if your cash on cash ROI is probably between 7 to 9% on the low end, you're going to meet that debt service ratio, right? Because I always recommend 1.2. So they're saying 1.1, which is great.
Right.
And basically that means any property over effectively 100 grand, you're golden, which is basically every market out there.
Which is really interesting also for fix and flip or BRRRR method investors where, they can get our construction financing on the front end. And then on the back end of this, they can go through and refinance. And we already have all their backup documentation and everything to refinance into a 30-year fixed. And, trust me, I personally was trying to go through and qualify and get everything together for a Fannie Freddie loan for 8 properties because I'm in the process of, I have some and I don't have any Fannie Freddie loans other than my primary residence in my name. I just never needed it. I use the commercial stuff. I use private money and things like that. And so, and I just had a lender that strung me along for a month and a half and then ended up being 2 months and she just quit the company. And they're so backed up and busy. And can they understand that I have 15 different entities that I own and all the flow throughs that come from that and backing up depreciation on each one of those to make sure that they show that I have proper income to qualify. 90% of the brokers out there that are doing these just don't get the complexity of my situation. Right. And I qualify no problem, but they just took me along forever and I just forget it. I'm done when I could have had this other one completed in a month, with the commercial side and be done with it and not even worry about it in the first place. Right.
100%. And this is the fascinating thing, right? This is what happens when entrepreneurs get hungry. They see hurdles. They're like, you know what, screw it. I have a need in the market. I'll create it myself. And here you go. So I got to ask, the lenders that are giving this capital, is it like a big bank? Is it like a small group of people?
So it's hedge funds and banks that got together the commercial banking market that got together to create this. And so the way it works is there's typically lenders out there that have this set up with these bigger banks and they have correspondent programs and things like that to be put in place. So, I'm not personally going to go loan my money at 5.5% interest rates. I just know how to get it. And, and I'm set up specifically to be able to do it in pretty much every market around the country, which is pretty cool. So, I think Nevada's out, North and South Dakota. There's a couple of other markets. Minnesota, I think, is out, but otherwise pretty much every market in the country, we can go get this financing from, which is massive, because if you're sitting there waiting for Fannie Freddie, or you're going, this property is not selling. I don't want to go and take a loss on it. Let me just go refinance and long-term. And, if you don't want to deal with Fannie Freddie, or, you won't qualify for Fannie Freddie, or you have too many of them, them, or you just want to do volume. This is a perfect program, for that type of client, which is huge. So just to get out of
just the unlimited factor and the fact that they'll lend to an LLC that doesn't have, proof of revenue is
massive.
That's a game changer. It's a game changer. 100%.
Yeah, the revenue is the actual cash flow from the investment, just like any multifamily deal, right? So,
man, so this is I love this. Okay, so if I'm listening, I'm sold, right? So, Tom, Matt, how do I start? Where do I go? Who do I talk to?
So you can just hit us up. You can go to ocgcapital.org or ocgproperties.com and contact us that way. You can also email us and invest@ocgproperties.com, or, you got my email, so just call you.
So let's do this. Let's do this. I'll make it easy for everyone. I will put links in the video below. This is on my podcast. Go to the description. You'll see it there. Reach out to me. I'll put you in touch with Matt. And this is, it's funny. I've been trying to, I ebb and flow on my properties. I have some stable ones, but I have cash buys and everything else. I just didn't, like you, I just never really tinkered around with the FHA loans. And now I'm like, well, I should probably max them out and then move on from there.
But if you look at the long-term inflation aspect of this, you want that 30-year fixed and the interest rate risk aspect. And, you just want to be able to hold these and keep a little bit lower leverage, because what if rents drop by 10%, or there's other strategies. Make sure you can weather that storm. And, I have the same thing, right? I had some properties that I'm going, hey, these ones are performing. A couple of these are killing me a little bit. Like, how do I fix those problems? And I realized after doing the analysis and researching every single one that has ever a problem is it's due to a number of issues, right? The first issue is a vacancy issue or something like that. Then the next one is usually repairs, right? And so, and those repairs can be counterbalanced by doing a couple of things, and the vacancy factor, where, we put a 5-10% vacancy factor involved in our average cash flows. We put a repair allowance in our average cash flows. And if any CapEx is needed up front, where major systems are on their last leg or need replaced in 5 years, put that money aside. And then every month, take out that vacancy factor, take out the repairs factor, and also put that aside, because usually it's when the tenant moves out that you have the rent ready, you have the vacancy happen at the same time, and then you might revamp a major system. So
I'm spending $2,500 to $3,000 per unit on my turns. It takes about 3 to 4 weeks, which is a pretty quick turn. I use Hemlane for my management. It's just fantastic, but they are costly, and I actually see that plumbing tends to be my most common. Like beyond like the small stuff and like the paint and all, really plumbing tends to be the biggest problem I come across. But this is again, for everyone out there, this is a game changer. So, to your point though, too, with interest rates, we're probably in low territory for several years. But it is going to be going up over the long haul, right?
And I think it depends if the Fed loses control or not, because the only way to counterbalance that interest rate is more inflation. And as they do more inflation, interest rates typically rise through that process. So
and by the way, they're still under their target of 2 to 3%, right? So they're not going to stop printing money until we hit that.
They're continuing, especially with the new admin. The way that's what they want.
It's going gangbusters. And by the way, I just heard about I saw a $3 to $4 trillion infrastructure bill coming out. So that's coming, by the way. So
they might as well. I mean, at this point, socialism is already here.
Free lunch, everyone.
I'm reading a book right now called The Nomad Capitalist, and he's on YouTube, and I listen to him all the time about how to actually go where you're treated best and learn the strategies that the super wealthy know about, going to the Caymans and things like that, and how to structure.
What's crazy? So I have this conversation with my friends too. It's like, look, and the thing is, no one wants to talk about money. It's kind of like a taboo topic because it's a little crass in some ways. Well, the thing is, like, I hate to say it, but for a long time, I have not used a solo 401k. And like, what a massive tax savings that instrument is. And all these little nuggets of tax savings exist across our system. Real estate's a big one. Owning a business, everyone should own a business. And so, to your point, like you learn piece by piece how the wealth become wealthier, how you exponentially grow your wealth. And I think just naturally you learn these techniques. You learn about loans that have unlimited caps or that can fund your LLC. And as you become more curious, you find these techniques that will make you wealthier, right? And so again, anyone out there, if you're listening and you're serious about investing, this is a fantastic program that I will definitely use myself. So.
Yeah, it's interesting. You have so many strategies to learn, and it really comes down to understanding them and then understanding what resources are out there to help you, because the
Yeah.
resources are everything. Every time I meet a new person, there's one way that we can help each other. And some 90% of the time you don't know what it is up front. And then
Yep.
it might present itself 5 years later and you didn't even realize they had that skill set, or or a million different things that could come up. Right. So
Yep.
I just did a podcast with somebody that is, has $1 million. I had no idea, and just wants to, place it. And I'm going,
Yeah.
great. So
Yeah. Yeah. That's awesome. Not agreed. Yeah, definitely different times nowadays. And I think those that just think the conventional way of putting your money in a 401k and doing a 9 to 5 they'll be left behind in no time. So.
absolutely. Yeah, I
So.
agree that you have to be very aware of what you're investing in, always looking and always learning, because, for example, in 2020 now, with the tech going the way it is, if you don't learn how to automate your entire business as best you can and structure things, you're not going to be able to scale correctly to meet up with
100%.
the iBuyers, with all the
Yeah.
other different, competitive things that are out there.
Oh,
So
100%. In fact, I have a book. I'm looking for the book. Yeah, right here. Right here. So this book, right? Who Not How. Okay. This, to me, it's a simple book, but it is a game changer, right? Dan Sullivan, great author. It's this idea of, scaling your operations, right? I have a client that has 25 loans out for private money, and she manages all of them. It's like, that is, you got to hire an assistant, pay them $16 an hour, and have them do that. That is bananas. So scaling up is to your point. If you really are serious about becoming wealthy, you have to do it. So.
yeah, and if you think about the structures of what we have to have, we have hundreds of loans out right now. If we don't have a system set up for
Oh
that,
yeah.
and a full-time, servicing person to help with that aspect of things, and underwriters and processors,
Yeah.
and accounting people to do all that, it really adds up. And so making sure, and then also managing projects, making sure when, hey, things are going wrong, you're able to step in and handle things and take care of people. And that aspect of things, it could get over your head super fast if you don't
Yeah.
have ways to track it correctly, and you can grow way above what your means are, and it'll cost
Yep.
you money. It's cost me money before. I lent to the wrong people. It cost me 300 grand a couple of years ago, on a loss that I had personally when I went through and lent to the wrong person. I lent $2 million to the wrong person, and he
Oof.
screwed me. So,
Yeah.
and it lied to my face, and you learn some hard lessons that way. At the same time, did that take me down? Not even close, so
Yep.
because I have proper diversification on all my investments, even though, and proper systems in place to be able to counterbalance even those risks. It could have been a lot worse if I would have let it go further, or done things wrong. So,
Yep.
and you just learn along the way.
Yep, man. I could do this for another 2 hours. Just really good content here. But again, for anyone that's interested in, or if you have your max 10 loans or whatever it is, or if you want to be introduced to having your LLC do the loans, reach out to us. I'll put you in touch with Matt, and we'll go from there. Matt, it's been awesome, man.
Thanks, man.